It was 30 years ago today, on October 19th, 1987, stock markets around the world suffered one of their worst days ever. The Dow Jones Industrial Average plummeted 508 points, the largest single-day loss for global exchanges since the Great Depression. The event came to be known as Black Monday. Jerry Kronenberg, managing editor for TheStreet, is here to talk more about this. Jerry, welcome.
Welcome.
So off camera a moment ago, you were telling me you remember this day very well. Just briefly, give us a sense of what the feeling was as you were watching this unfold in real time.
Sure, absolutely. Well, then as now, we had a lot of political division in this country, and Ronald Reagan was the president, and a lot of people loved him and a lot of people hated him. And he himself compared himself to Calvin Coolidge, the president of the 1920s, and it was like the Roaring 20s, the Roaring 80s. And for a lot of people who did not like Reagan, it seemed like we're going to pay the piper sooner or later. And you get up and you turn on the TV, as I did, and the stock market's down 200 points, which would be like 2,000 points today. And it's like, uh-oh, have we just fallen off the cliff? Is this 1929? Is this the Great Depression? Is this the rise of, the Hitlers and the Mussolinis?
So what caused it? In hindsight, of course, we have that benefit to look back, but what were the causes?
Sure. Well, there's a lot of research, and I actually, over the years, happened to interview some people, including some people on a presidential panel that Reagan commissioned. And there's a number of factors. One of the big ones that caused it when it happened is that interest rates were the opposite of what they were now. They're going very high. And so that summer, you could get 10% on a treasury bond, which actually equals what you can normally get on the stock market historically. So why would you have your money in the stock market? You just took it all out, put it in the treasury bonds, and that dropped the stock market. But there's a very key thing, which is a type of computer program called, they called it portfolio insurance. And as the stock market fell, a lot of these professional traders would actually do something called shorting the stock market, shorting the S&P 500 futures. So that you'd lose money on your stocks, you'd make money on this portfolio insurance, but as you shorted more, you pushed the market down more, and you got this vicious cycle, and it kept going lower and lower and lower.
So what was the real impact on the global economy?
Sure. Well, surprisingly enough, it really wasn't that bad. The market recovered a year and a half later and got back to where it was. And we actually got a recession, but it was about 2 years later. So it looked very scary, and the concern was with 1929 and 1987, and again in 2008, is that if you get big banks losing a lot of money, that usually isn't what causes a depression or recession, just the losing the money. It's nobody knows who's going to go broke, so no one lends to anybody. So good businesses can't get loans, and everything collapses.
Well, so what's being done in the wake of 1987? What steps were taken to ensure that that wouldn't happen again?
Sure. Well, that's a great question. One thing that is in effect now, and it probably helps, there's something called the circuit breaker rule. So if the stock market were to fall 7%, 13%, or 20%, which in today's terms would be quite a bit. 7% is 1,600 points on the Dow, which we haven't seen ever, actually. 20% would be 4,600 points, which we've certainly never seen. You would actually stop trading for 15 minutes for the first two circuit breakers, and then for the end of the day.
The machines just stop.
Well, you would not be able to place a trade. Everything shuts down. And that's good because we're in actually a more precarious spot right now because the computers are stronger. We talked about portfolio insurance. There's much more complicated computer programs now. And we actually had in 2010 something called a flash crash where the Dow dropped 600 points and came back all within the space of about 20 minutes. And that was thought to be a computer glitch, but if it happens and it gets worse, you can't all just say, oh, well, let's just forget today. Let's just go back to where we were. A bank could go under, another bank could go under, and you could have this massive calamity. And we're actually in some ways at higher risk now than we were then.
In more recent times, we've talked about the Great Recession. I've talked to millennials, for instance, who have been severely impacted by the effects of that. Is that something that could have been prevented?
The Great Recession
of 2008.
Well, yeah, there's a lot. This shows some similarities between 1987 and 2008, maybe now. You always find out after the fact what you didn't have regulated, depending on your point of view, properly. So everything looks great on paper. So in 1987, this portfolio insurance sounded like a great idea. Nobody realizes if you run it on steroids, it falls apart. 2008 and leading up to that, subprime mortgages sounded great on paper. You loan a bunch of people money at high interest rates, and a percentage of them go broke, but a percentage of them pay and you do okay. Turns out all of them go broke, and it doesn't work out now. The problem we have now, again, we have similar, very complicated program trades. Nobody really knows how they're going to work if things go wrong. And again, a computer doesn't think like a human being. They don't worry about the house. They don't worry about the mortgage. If the conditions are a certain way and the computer program says sell or buy, they're going to sell or buy. and you can get the swirling effect. So it's a real concern.
Yeah, that doesn't sound very comforting, I would imagine, to some people. So against that backdrop, the Dow surpassed the 23,000 mark for the first time this week. The markets also rallied, though, in those months leading up to the 1987 crash.
Correct.
So are there concerns that perhaps
Correct.
what happened in 87 could happen again?
There are similarities and there are differences. Let's talk about the differences first. I think the biggest thing is you just don't have the passion and the market is at a record. Everybody says it's a record. Everyone says it's too high. They actually blame the computers because every time it goes down, the computers are thought to be pushing it up to make a few bucks. But there's not the excitement of the 80s or the 90s with the tech boom where everybody's thinking like millionaires. Everybody that I talk to, whether it's younger people, older people, they're more worried about falling behind, not becoming rich. So it doesn't seem like there's that excitement. But the similarity, again, we're actually more overpriced on stocks than we were then. In the summer of 1987, a measure called the price-to-earnings ratio, which tells you how expensive the Standard & Poor's 500 is, that was at about 21. And then it fell a little bit, and in October 87, it was at 17. Historic is about 15.5. We're currently at about 24.5. So we're actually more expensive than we were then. But countervailing that, there's just not the feeling that everything's crazy, yeehaw, I'm going to throw my money in, and that's where you tend to get the crash. So it's an odd situation.
Cautiously optimistic then, perhaps? That we're not
the
going
general
to veer
feeling
into
is that we should go down, but we keep grinding higher. And my advice to people tends to be, whether you're in your 20s, whether you're in your 50s, be comfortable with what you have. If the stock market dropped 20 points and you freaked out, you're not doing the right thing. If you've got a long-term thing that you're happy with, I wouldn't even worry about it. During the 2008 crash, I actually bought stock. It turned out to be a good idea. And basically be weatherproof for whatever goes on. Make sure you know what you own. Make sure you know what's in your 401k. Contribute. Be comfortable with what you're doing and just weather the storm. Don't panic.
All right, Jerry Kronenberg. Thanks so much, Jerry.
Thank you. Great to be here.